All right, thanks, Jeff, and thanks for everyone for joining us. My name's Matthew Lemieux, and so what we're going to be talking about again is fund flows for the second quarter 2012. As you can see, we do define these as preliminary, and the reason that we do that is because we just haven't quite got all of our June month-end data in there. There's still some fund families that have yet to report, but these numbers really should give you a good idea of what we've seen so far in the quarter. Also, kind of just to clarify, because we have had questions when we're talking about the flows, most of the time we're going to be talking about mutual fund flows. I will touch briefly on ETFs. And when we talk about the mutual funds, this is going to include all open-end funds as well as variable underlying funds. So the reason we do this is it remains consistent with kind of how we traditionally have reported fund flows in our monthly reports that we put out about the 12th business day every month. So,
which, by the way, is in line with the ICI.
Which is in line with the ICI. That's right. So let's jump to the first slide here. And really what we've seen in Q2 is something that's very similar to what we saw preliminarily in Q1 if you were with us. Really kind of a mixed bag for equity, even though last quarter we saw a little bit more volume for the world and sector equity. Large flows for taxable and municipal debt, and then large outflows for money market funds. And so we continue to kind of see that within this quarter. Overall, Q2 mutual funds lost about $10.5 billion, while ETFs pulled in about 14.8. So still similar, same story as we saw. We did see the mutual funds turn positive for flows in Q1, but really kind of the lag that we've seen in U.S. diversified equity as well as the drag from money market funds pulled the whole group down into the negatives. And so kind of let's just go through this really quick. U.S. diversified equity continued really to struggle, almost $30 billion coming out. It's really not a surprise. This is a group that has continued to really struggle garnering assets ever since really the downfall or the downward spiral we saw after 2008, where everyone really rushed out of equity. We still haven't seen any kind of surge coming back into that, especially in the mutual fund space. We've seen some investors come back into diversified equity through ETFs this quarter, relatively flat with about $200 million. Sector equity really kind of struggled this quarter, and it wasn't a big surprise as we look through Tom. They kind of struggled for performance, 4.2%. A lot of times it seemed with sector equity. Investors are looking for some inspiration there before they decide to go into that group. It was really quite a struggle, especially with oil prices pushing down natural resources type products. ETFs did a little bit better, about $2.9 billion coming in. World equity continued to draw assets, and a lot of this really is on the shoulders of emerging markets. Even though we've seen some poor performance in that group, investors continue to allocate money towards world equity, ex-US, about negative 7% performance for Q2, but continue to draw assets with $11.2 billion. And on the other end, with the ETFs, we saw about 5.5 go out, and we'll kind of show where those losses came from. Taxable fixed income continued to be strong, about $45.5 billion. And also we start seeing a little uptake and a little bit of market share kind of being taken away from mutual funds into the ETF space with taxable bonds this quarter at 16.6%. So a lot of investors seem to be feeling a little bit more comfortable getting that bond exposure through index ETF products. Municipal debt continues to be strong. They had a really kind of a rough year, or a rough patch last year when it came to flows. This quarter up $10.2 billion, so it follows a good quarter last quarter as well. And we see a little bit of movement in the ETF space. Not too many products out there with the municipal debt, about $600 million. The next story is money market funds. Year to date, they've lost quite a bit of money, as Tom had said. This quarter, about $67.9 billion. Investors really having a hard time keeping their cash there. Depending on the environment, coming back into risk, it's difficult because there's no yield there, negative yields in often cases, and also, as we'll show, there's some tax implications there. And then usually I haven't shown it, but we'll talk about mixed assets because Tom likes to touch us, and it is really kind of an important piece when you're talking about flows with mixed assets, especially with a larger surge of money going into target date funds. But not only that, but also global flexible type products that investors are looking at, wider mandates giving them a little bit more flexibility in their portfolio. $19.6 billion into mixed asset funds this quarter. So let's move on to ETFs. Again, like I said, we're going to talk mostly about mutual funds, but we do want to talk about ETF trends. As I said before, about $14.8 billion total going into ETFs this quarter. Really not quite as heavy as we saw the previous quarter, and really kind of what I wanted to show you is some cumulative weekly effects of what we've seen with ETFs. These are some of the larger ETFs that we have that are most well used. The first one is SPY, Spider SP 500. I really like to show this because we do see this as a very heavy trading instrument within the industry, and we see a lot of volatility within the SPY depending on the market sentiment. Overall, we saw about $2 billion go out for the quarter. This is almost exactly what happened last quarter with a lot of volatility, ups and downs. It ended about $2 billion out. The next one is MSCI EFA, and then also MSCI Emerging Markets. So as I had mentioned on the last screen, these were really kind of the larger outflows for ETFs when it came to world equity, and in both cases 1.8 to 2.4 out. The move for the MSCI EFA was again similar to last quarter. Last quarter we did see actually a lot of positive sentiment and flows on the ETF space for the emerging market index, so we saw this move negative this quarter. Triple Q struggled, and one of the, if you look at it, the LQD, which is the iShares investment grade product, really quite steady. So investors felt very comfortable kind of going more towards quality as compared to last quarter, which a lot of investors really kind of went towards the high yield. We saw a little bit more volatility in high yield this quarter. HYG ended pretty much flat, and gold ended pretty much flat as well. Not much going on there. Investors really weren't feeling too comfortable, especially with some struggles in performance. But overall, if you look at H1, Q1, and Q2 of 2012, we've seen inflows of $67 billion, and this is going to be the largest on record that we've seen for our first 2 quarters of a year, following up last year's, which was about $51 billion for H1 2011. So investors, we see a lot of articles out there. We hear a lot of people talking about how the ETFs are going to be the mutual fund killers. Who knows when that's going to happen? I mean, really, they are approaching, or they've been at about $1.2 trillion since the end of Q1, which for the most part is great that they're over that much, but they still have quite a ways to go before I think they really challenge assets of mutual funds. So let's look at the equity funds really quick. We'll kind of go through the gainers and the losers. So if you look at the top of the U.S. Diversified Group, once again, for actually the 7th consecutive quarter, equity income funds were the top receiver of net assets at $1.8 billion. Investors continue to feel comfortable if they're going to go with the equity exposure, that they're going for dividend payers, that they're going to seek that yield, especially since it still looks very good compared to what we're seeing in the bond market in a lot of cases, especially versus treasuries. The second group, especially diversified, this is going to be kind of your indexed enhanced type products, but $1.7 billion in, and then multi-cap core products, which I thought was a bit surprised, but these are going to be kind of your go anywhere equity products, $1.3 billion into that group. For the sector group, I think we really saw the funds that did well really kind of followed performance, as I mentioned before. I think sector equity, a lot of times the case needs to be made for investors to kind of jump into that group. And we started with global real estate funds with $1.1 billion of inflows. And I think some of this really came late within the quarter, especially as we saw that group pulling about 6.3% in returns in June. Health and biotech also did quite well, $516 million. And then real estate, $462 million. And again, real estate and health, if you looked at the numbers, and Tom went through them, those were the top performers for the sector group for the quarter. World equity funds, very similar story that we've seen to U.S. diversified equity. Emerging markets, even though they haven't had quite the run that equity income has, they continue to be on the top of the list. Investors, even though performance again has been struggling, investors are still broadening their base. They're diversifying their equity. They feel that emerging markets is going to be a better position, that once we do get that growth story going, that they'll be positioned there. $6.1 billion into that group. This is the second quarter in a row that it was number one. Global Taxable coming behind that, $4.6 billion. Again, second time that we've seen this group in the second spot. And then the last one is an international large cap core, about $4 billion coming in. On the downside, a lot of the same stories that we've been talking about over the past several quarters. On the U.S. diversified equity side, large cap core continued to struggle, $15.7 billion out this quarter. That compares to $18.2 billion out last quarter. Large cap value funds pushed out about $6.1 billion this quarter. It's compared to about $5.8 last quarter. And then actually somewhat of a surprise was small cap core, negative $3.2 billion. And as Tom had mentioned before, it was somewhat of a surprise, especially since that fund, or that the small cap group performed quite well in June. So some investors still kind of shunned that through the quarter. Sector, not too much of a surprise. It's this first one here, global natural resources, with oil struggling as much as it did. We saw about $1.5 billion coming out of that group. Science and tech, about $533 million, and global health and biotech, about $277 million. So on to the last group, world equity. Similar story to U.S. diversified equity. Some of these groups we've seen that have struggled for quite some time. Large cap core, $1.5 billion out. Global large cap value, 1.3. And global multi-cap value 1.3 as well. And so those really are not too much of a surprise. Diversified products, whether they're domestic or global, really have struggled with a few exceptions here and there. On to the taxable bond side, we really actually see some a little bit of change that we've seen over the last couple quarters. Really the story has been for flows, who was going to take the top spot between intermediate investment grade or core type products, and then the high yield products. Last quarter we saw intermediate investment grade bringing in roughly $22 billion, and high yield not too far behind at $17 billion. This quarter is a little bit different. At the top we saw Lipper corporate debt funds, BBB rated. These funds, as Jeff mentioned, did quite well for the quarter. I think they're up about 2.4%. A lot of these flows, I will say, because we do cover or include variable annuities, we did have a very large subscription for a couple BBB rated products, but overall they still did quite well. The second one has kind of been, I think, the surprise, or maybe not too much of a surprise, but it's been quite steady for a while, even to the last quarter. Last quarter we saw it about $7.3 billion. This quarter, the Lipper U.S. mortgage funds bring in about $6.8 billion. So investors seem to feel very comfortable with investing back in mortgages. I think that there's some thoughts out there and some joint sentiment that we're probably towards the bottom of the housing market, and that hopefully we're not going to see any more short-term spikes in foreclosures. So they're feeling very comfortable with mortgage funds. And also, we see emerging market debt funds pulling about $4.2 billion. So that's another group that we've seen a lot of interest going into. Even though we've seen negative returns on the quarter, again, I think it's a similar story to what we're seeing on the equity side that investors are looking for the diversification, not only of the country exposure, but we've seen a lot of interest towards what we call local currency type products. So they're getting a little bit more diversified exposure away from the dollar, which may have kind of hurt them in this last quarter as the dollar strengthened. If you look kind of towards the bottom, we see a mix. There's really not a big outlier, but we see a lot of groups that had $1 billion plus in. So, I mean, as opposed to last quarter, we saw a lot of money going into intermediate investment grade and high yield. It seemed much more diversified. We really didn't get much traction this quarter into high current yield, only bringing about $1 billion. And also the Treasury type products, the TIPS products, as well as the short and general U.S. Treasuries, really didn't do much. Investors not looking for too much exposures, at least through the funds. Even though we saw great performance, it seemed like. And then at the bottom was not a big surprise for flows if you compared it to performance, which is currency funds. It was the worst performer for the taxable bond group, and it also pushed out the most inflows. Third group we're going to do is municipal bond funds. As I mentioned, this group has done quite well. We've actually, if you look at it on a weekly basis, we've only seen 1 week of outflows in H1 first half of 2012. They posted about $10.2 billion total for the quarter. A lot of that really kind of picking up in May and into June. So, as we had April, we still had a lot of people feeling comfortable with risk, slowing down a little bit. And then as people shifted to kind of out of that risk type appetite in May and June, it seemed like municipals really kind of benefited from that. I feel that the yields probably were beneficial, as well as I think a lot of people, now that they've seen that the whole municipal market hasn't defaulted, that there's still relative safety there for them. If you actually look at the first half of 2012, like I said, we only had 1 week of outflows. We saw about $24 billion of inflows during that time. And again, this really contrasts to the struggles that these products had last year when we saw about $15.3 billion in outflow in all of 2011. So I think a lot of the municipal market is feeling pretty good at this point. And the last group is going to be money market funds. Again, this is a group overall that's continued to struggle. As I said, we've seen well over $100 billion out in the last 2 quarters. April, we saw about $23.8 billion. And again, I think we just come off a very stellar first quarter when it came to equity markets. And I think that the thought was the investors were feeling more comfortable going back into risk, especially if you kind of look at the split out. At first, I would assume that maybe we saw more institutional, but it was actually the retail money markets, $15.4 billion that we saw the most outflow. So investors, seems at least the retail investors maybe taking some of that money and putting it to work. May, we saw about a net inflow of $1 billion from money markets. That's relatively flat, no large movements within that period. And then June, again, large outflows, $45.1 billion. Again, I think a similar story to what we saw in March when we were talking about Q1. A lot of outflow pressure from corporate tax liabilities. June 15th, we had a corporate tax deadline, estimated tax deadline, and that week alone we saw somewhere around $24 billion in outflows. So a lot of that pressure coming from there. So overall, I know that Jeff and Tom had kind of mentioned, and I'll touch on this very, very briefly, is looking forward with flows as we go into earnings season, as well as we see the U.S. Presidential elections coming upon us. I think it'll be very unlikely to see any large shifts, especially in mutual fund flows. I think we'll continue to see investors going towards fixed income, and I think that it'll continue to struggle for equities. No investors really, at least on the retail side or the mutual fund side, really feel comfortable to put both feet in towards risk. So it'll be kind of a flat, and I don't think we're going to see any too many surprises until we see a little bit more stability after these events are done. So I'm going to move this on and pass this to Sasha Fronger.